Hey, Market Rebels, welcome back, everyone. I hope everybody had a fabulous weekend. And just watching the markets here, looks like we're up another % on the SPY, so a good push from Friday. I mentioned about that last week where it was important off of that 1,000-day moving average. So I have to see if we can keep the rally going. Unfortunately, we do have a lot of different market-moving economic indicators that are going to be coming out this week, so we'll have to see if it can hold. So before I get started for today, do have a little bit of, where did it go? There we go. A little bit of a plug for our Miami event, which most of you know about, but many of you may not. December 8th through the 10th, it is going to be a live trading event. So if you like stuff like this that you're hearing on Trading Tune-Up, it's going to be jam-packed with all kinds of trading, live trading, Q&A sessions and things like that. So if you're interested, you can certainly visit marketrebellion.com. So with that, let's take a look at today's topic. As I always like to talk about, I want to make sure that we cover topics that are the things that you're probably not used to seeing. I don't want to come up here with, here's what a vertical spread is, and here's a covered call and things like that. I want to show you the places where traders usually make mistakes, or those traps that are easy to step into. And this is one of them. Should you roll out early? I see a lot of traders making mistakes with this. Now, of course, there's a lot of different combinations, whether we have an at the money, in the money, out of the money, and things like that. But for today, I'm just going to talk about rolling out and at the money. Why traders do that and why that is usually going to be a bad idea. So with that, let's go ahead and get started. First of all, what is a rollout? Well, a rollout is where you are going to sell your current option and you're just going to buy a longer dated option with the same strike. That's what makes it a roll out. We're keeping the strike the same, we're just going out in time. Now, yeah, a lot of people will go up and out, meaning they've rolled up in strike and out in time. All right, so we use the terms in and out to refer to time. So for a rollout, we are just keeping the strike the same, but we are just going to increase the amount of time. Now, why do people like to do this? And why do they like to roll out early? So for instance, maybe they bought a 6-month option and it's now down to the last 30 days or the last 45 days or something. And they say, oh, maybe I should roll it out. Well, here's the reason that they do it, is to reduce time decay. So we're going to see, which we've seen before, here's our at the money time decay curve. And as I talked about in a recent tune-up, the first 75% of the time that goes by, you are going to lose 50% of that value. Now remember, this is assuming everything else constant. So the stock price stays the same, which of course is probably not realistic, but that's what we're assuming here. Stock price hasn't moved, volatility hasn't moved, nothing else has changed. We're just letting time slip by. So it's going to take 75% of that option's time to bleed out 50%. So in this graph right here, I've got a 100-day option. That's what you're seeing over here, 100 days to expiration. At the far right is 0. So you can see all of this in green comes down to where we have 25 days remaining, and this option has lost 50% of its value. All right, so we can see that it started out here at 10, and right there is 5. So it's lost 50%. So what does that mean? It means in the final 25% of the time, you're going to lose exactly the amount that you did in the first 75%. And again, this is why traders go, oh, don't fall into that steep portion of that time decay curve. You have to roll it out. Well, like all questions and options, it depends. There are some cases where it will make sense and others where it won't. So for instance, let's take a look at rolling and at the money. Let's say you have a 30-day $100 call and you're considering rolling to a 90-day $100 call. All right, so will rolling to a 90-day call improve your performance? All right, so that's the question that we're trying to address. Well, here's the two options separately. So this is run in a pricing model, so they're not made up numbers. So this red curve is the $100 call with 30 days to go. The black curve is the $100 call with 90 days to go. So they've got the same strike. We just have more time. Now, what do you notice? Right, so here's our stock price right here. Notice that if we compare the slopes, the angle, remember that's our delta. Your deltas are actually greater on the longer dated option, on the 90-day. You can see how this black line is a little bit steeper compared to this red. Red's almost just dead flat. All right, take a look up here. Deltas are actually smaller up here. In other words, they're steeper on the red line. They're not, I mean, yeah, they're steep, but they're not quite as steep as they are on the red line. All right, so if you have trouble seeing that, I've used this analogy before. Think of looking at a snow ski mountain from the side. If you've got one skier up here skiing downwards on this red line, you're going to be going faster than the guy that's on this black line. All right, so they're both on steep slopes, but the red is much steeper. So what does this mean? Well, what it means is that if you go from the red to the black, in other words, you roll out in time, that you're actually going to be opening the doors for bigger losses, right? Because you have more deltas to the downside and you had to put more money into it. Notice that if the stock falls, we're only going to be losing, looks like about 350 on the red curve, but a little over 6 on the black. All right, so we start cutting off these losses much earlier on the short dated call. If the stock rallies, what happens? We outperform with the short dated one because our extrinsic value goes to zero much sooner. So the point is that if the stock rallies, we're better off with our current 30-day option. And if the stock tanks, we're better off with our 30-day option. Now that's just talking about deltas. We haven't talked about vegas or other considerations, but what I'm trying to show you is why this can be so tricky. So you can just see from here, why would we want to switch from the red to the black and pay money to boot? But that's what you're doing when you're rolling it out. Now, to show you why it can be so tricky, some people will put this into their platform. This is going to be for, I believe it was about a 350 credit. So again, let's say that this option here in red, the 30-day is maybe trading for 350. This one's trading closer to 7. All right, so it was trading about a little over 6. It's got 3 times the amount of time on it. So it's like a $3 and something credit. A $3 and something debit. So here's the problem. When you put this onto your platform, is that if you go from the red line to the black, what you are effectively doing is you're trading in the one in red, so you're getting a credit of $3 and whatever it is, and then you're paying the $6 or whatever it is for the black line. So notice that this black line and the green line are virtually the same. It's just that the green line is shifted up by the amount of the debit. See, what's actually happening here is that you're buying the black line instead of for 6 something, you're buying it for the price of the red. And so it can give you the appearance that the green line outperforms at all stages. It's not outperforming, it's just more valuable. It's because you've purchased a more valuable option. But once you understand to look at slopes, the slopes are not as great on the green line as they are here on the red, and they're definitely greater down here than they are for the red. There's really no reason to do that. And yet traders do this all the time. Why? Because they always hear, I'm supposed to roll out when I get close to expiration. The answer is sometimes you should, and for the right reasons. And this is why it's important to know all of the details. Now, there's another big issue that comes into play. Let's say that you own a 30-day $100 call, and this is the price that I had in the pricing model. So it was $3.43. And let's say, should you roll to the 60-day $100 call, trading for $4.85? All right, so we want to go to twice the amount of time, and that same pricing model, again, these are not made up, these are run in a pricing model, says that option is worth $4.85. Well, here's the reason that people think that. They go in 30 days, this will be worth $3.43, right? Assuming all else constant, this 60-day option will be a 30-day option and should be trading for $3.43. So if I can pay $4.85 and sell for $3.43, I'm only going to lose $1.42. And they say, hey, that sounds a whole lot better than losing 343. Possibly, but we always have to remember that there is a cost associated with it. So I want you to think for a moment, how much are you going to have to pay for this benefit? See, that's another angle that most traders never look at. They go, oh, it's obvious. Look, I'm going to save. It's only going to cost me $1.42 as opposed to $3.43. But what if it's going to cost you $5 for that? See, that's always the thing. Yes, of course, we can always go and fish out some benefits, but what is it going to cost? All right, so let's do that. Let's bring up a, let's see if I can bring up my Excel spreadsheet here for you. So we should be seeing the Excel spreadsheet. And what I've got is these are both $100 strikes. All right, so we've got time up here you can see is 0. Here's 30 days to expiration. Over on the right, we're going all the way, actually even way down to 90. But the one that we're looking at right now is this 60-day option. All right, so these are the option prices. And then we're doing the same thing for, and this is originally a 120-day option. So these are all of the prices for a 120-day option. Now, what I want you to notice is that when this 120-day option gets to have 30 days to expiration, what do you notice about that price and that price? They're exactly the same. That's what I said before. When there's 30 days remaining, all else being equal, it should be the same price as another 30-day option. All right, so that's one of the things that you have to remember. So now let's take a look. If I want to roll from this option, all right, so here's the scenario again. I've got this 30-day option. I go, if I hold it, I'm going to be losing $3.43 all the way to expiration. I don't want to do that. So instead, I'm going to cash this one in. I'm going to sell it to close. I'm going to buy this one out here that is worth $4.85. What's the net debit right there? Right there, $1.42. All right, so I got to pay $1.42. But how much am I going to save? Well, if I pay $4.85 and I can sell it for $3.43, I'm going to save $1.42. Again, it's because those two numbers are the same. It's going to cost you $1.42 to save $1.42. Is that really a big benefit? Not in terms of dollars and cents, maybe in terms of Vega, maybe in terms of other things, but not in terms of dollars and cents. And yet that is the primary reason that traders roll, is to try to save money. And all they've done is they've put more money at risk, lowered their deltas if the stock rises, and raised the deltas if it falls. It's just not a good move. And again, traders do this all the time. So how could we know this? Okay, for all of you who know your options pricing, which we've talked about before, we've got twice as much time, which means we should have the square root of 2, which is 1.41. So if you take 1.41 times 343, you'll get 485. And there is our difference right there of $1.42. All right, so it all works out in the wash. And the main thing that I'm just trying to show here is that you have to pay for the benefits. So anytime you find yourself saying, oh, I need to roll out because I'm going to lose $5, but I can only lose $2 if I roll out, you're going to pay for that. Whatever the amount of the benefit is that you're seeing is exactly the amount that it's going to cost you. All right, now one final point. Let's go back to our PowerPoint. And that should be, why can't I find my, there it goes. Okay. So the question is, why do we have to pay for that dollar for dollar when we're buying time? See, we don't do that with an option. And here's a $100 call, let's say trading for 5. You have to pay 5, that's the most you can lose, but you can make unlimited gains. Why is that? Why can you pay a relatively small amount and potentially make all the money in the world? Well, that's because there is a bell curve over a stock's price. There is a potential for the stock to go to 110 or 120 or 130. No matter how small that probability is, it's accounted for. Does the Black-Scholes model account for the stock going to 120? Yep, it's going to give it pretty close to a zero value. but it's in there. But now I want you to think about time. Is there a bell curve associated with time? Not in the least. In 30 days, we know 30 days will pass. Or another way of looking at it, in 30 days, there's a 100% chance that 30 days will have passed, not 29, not 25, not 35. See, there's no bell curve associated with it, and because of that, we don't have to worry about probabilities. We know that if you're going to have a $2 benefit, it's going to cost you $2. It's always dollar for dollar, and that's because there is no bell curve associated with time. So anyway, those are some of the points that I just wanted to raise. We could look at all kinds of different scenarios, whether we're talking about in the monies or out of the monies. I just wanted to show you why it's not all that easy, as a lot of people make it out to be by saying, oh, you're getting close to expiration, just roll it out. Be careful of that. So as always, remember, if you want to get better with your trading, it's not about what you know that matters. It's the stuff that you don't know. And so we'd like to invite you, for anybody who wants to get better with their trading and learn a lot of tips and tricks like this that we talk about in Trading Tune-Up, to give us a call. Get a free, absolutely free 30-minute one-on-one consultation with one of our world-class coaches. The phone number there is 888-809-8058. Be happy to have a chat with you and can definitely show you lots of stuff you've never seen before. So I hope you please do that, and also please check us out for Miami. If you can do that, we'd love to have you. And with that, I want to wish everybody a great rest of the day. Hopefully we get a nice continued rally this week, and I'll see you on Thursday, 4 p.m. for our next Trading Tune-Up.